All right, we're live. How you doing, friends? And this is the Final Hour Show. I'm Coach Ernie, and today we're going to talk about. Well, we haven't had the countdown yet, so let's just do away with the countdown. Let's go right to it. Just realize that. Let's see. I think it's this. There it is. Got it. All right. I've also been fooling around with the frame rate, 4K, and everything. I noticed that there was some non-syncing with my lips, so it might be a little bit off. I hope it's fixed. If it isn't, then I'll fix it tomorrow. Anyways, today's show is about profit management. This is where the rubber meets the road. How do you manage profit in a butterfly that's out of the money using these kind of tail risk trades, convexity, etc.? Well, as you saw in the title, it's really all about gamma. Well, gamma is the principal component, and it's what really forces our hand. It's what's providing the opportunity and the risk. So we're going to take a look at that, and then how a trade starts, how we get into profit, come up with a framework for how we're going to treat the profit. But first, we have to understand the nature of how a trade progresses throughout the day. And this is not like rocket science. It is a very well-known phenomenon. If you understand it and you know where and when you are, then you can manage it. So, on the other hand, you can have all of these rules and everything, but stuff happens. There is something to be said for being opportunistic. But the profit management framework I'm about to show you is really designed to help you stay with the trade as long as necessary until the risk becomes untenable, and then you get out, you take what you can. But it will also allow you to achieve a maximum profit if it's in the cards. So, but let me say, what are the odds of that? What are the odds that you're going to pin a trade? That means that the market is going to move far enough into your position and then end at the end of the day right at your short strikes of the butterfly, right at the tip. Or even anywhere around there. I mean, anywhere within 10% of the tip of the butterfly is going to be a fantastic trade. And in our case, that might mean as much as 2,000-3,000% return. And if you hit it right on the button, it could be more. So it's pretty big deal. So that's what we want to figure out. We want to figure out how do we hang on to the trade long enough to allow that to happen. But remember that it's only about a 2.5% of the time that you're going to get right at the center strike. So this is a relatively low occurring thing. There are in about 12 to 13% of the time that you're going to be inside the profit tent itself. And then about 37-38% of the time that you'll be taking profit outside the profit tent. Okay, so that comprises what? 50% of all your trades. The other 50%, there's a pretty good chance that it's going to go against you. And that's actually where my 50% win rate comes from. 50% of the time it goes against me, 50% of the time it goes towards my strategy, and then I manage it. Now you might think, well, can't I figure out to go in the right direction beforehand? I wish there were a way. And when you find out how I can tell before the market opens which way the market's going to end that day, let me know. All right. So the first thing that we're going to... Oh, what is this? That is a fan, and it shouldn't be there. I'll bring Optimus into the picture here. He'll help with his sledgehammer. So first thing we're going to do is take a look at a butterfly. And let's see if I can get one up here that would be a good representative. Need to move that out of the way. How about this one? Yeah, this is pretty good. All right. So the first thing we're going to do is we're really going to talk about the mechanics. And now, a few days ago, last week, I talked about premium decay and the decay rate and all that, and what happens in low volatility versus high volatility. All that stuff still applies. This is going to be assuming that we're in a trade and price is heading towards our fly, regardless of whether it's in low volatility or high volatility. We've already adjusted for the volatility level by adjusting our width. So let's just assume that all that stuff has taken place. And when we're in a trade, it'll look something like this. I have it shaded out so that you can really get a good feel for that. I think I'll take that and all right, that's good. I'm ready now. Not that. We're going to the presentation. There it is. All right. So this is the way I break it down. When I'm in the trade, I'm in my butterfly, it's out of the money, and I really want price to go into zone 1 towards zone 2 or zone 3. And as I said before, these are the percentages of times that you would expect price to get inside of your fly. So the 10%, that's not additive, that's like total. So about 12.5% of the time total, you'll get inside of the profit tent. About 37.5% of the time you'll end up here, and 50% of the time you'll end up in negative territory. And so when we approach the butterfly, let's take a look. I'm going to change that. Wow, that's really cool. If we go standard, yeah, it's a little easier to see. So this magenta line represents the premium in your fly. All right, so there it is. That is the real-time profit curve, and then the blue line is your profit curve at expiration. Now, they both represent the exact same strategy. It's just that the real-time profit curve is in real time, and the blue line is the strategy at expiration. Over time, that magenta line is going to slowly move up, like that, until it morphs into the blue line. That's how the risk graph works, and that's basically what you're seeing over the course of a day. And so our job is to decide when the risk is too high and we're in profit to get out. All right? So we have to come up with some kind of strategy, some rules-based, but there's also some discretion in it on how we're going to act at different times of the day, because this is really a multi-dimensional problem. It's actually 2 dimensions. It's dimensions of time and where you are relative to your profit, your strategy. And that's why I break it down into these zones. So you can look at it as, okay, how do I break it down in terms of time? Well, during the day, we like to, and why do we break it down into time? We're breaking it down into time because over the course of a day, the premium is decaying, and it's decaying at a particular rate. I had another presentation here that really brought this out to light. I'm wondering if I can. It's too late. We'll just talk about it. So we like to break down the day into 3 primary segments. There's the morning session, the afternoon session, and then the closing session. The morning session is, all of these are Eastern time. The morning session is from the open until about 12:30. So you have about 3 hours. And then there's the afternoon session that goes from 12:30 to 2:30, so about 2 hours. And then the closing session from 2:30 to 4, about an hour and a half. And as you see, it's the time frames are diminishing as you go further out, because that's representing the change in premium decay. It is increasing, so you have less time as you get closer to the end. And we look at the morning session as 2 distinct sessions, or 2 parts of the whole. There's the first half and latter half. And the reason why we do that is that every day things change in a great way, depending on whether there's a lot of volatility in the market or a little volatility. We have a little flexibility now on how we treat that morning session. But we don't know when price is going to start moving towards our strategy. It could happen at any time. It could happen right out of the gate and just move very, very close to it. It could take its sweet time and not move until after the morning session is over. Or it could wait until the closing session before it decides to make a big move. And we've all seen that sort of thing happen at the end of the day. So we don't really know when that's going to happen, but we're going to be prepared for regardless of what time it is and how we're going to act. But there is a general principle. And the general principle is that profit curve is slowly growing, and while it grows, the real-time break-evens are slowly coming towards your profit, your actual strategy. Now, there are 2 break-evens in such a scenario. There's the break-evens here. Let me see if I can grab a shape. There are break-evens for at expiration, like this is one. And then this is the other, right here. And then there are break-evens on your real-time profit curve. That's like this one way out here. Let's see. Can I select that? Probably not. But it starts here, and then in the course of the day, it's slowly moving in here, while this profit curve is slowly rising like this. So later in the day, it starts looking like this as it rises. So this would represent later in the day. So hopefully that makes sense. Right? And then break even here. So that's basically what's happening during the day. So we can look at this as 2. So I'll look at it early in the day. This is early in the day. Kind of looks like this. There we go, like this. And then later in the day, it looks like it's as it advances and moves up into and eventually morphs into the butterfly, it looks like that. So you're so it's moving from this way to that way, like that. Right? And then profit is moving. Let's see if I can rotate this. Probably should have put all this stuff on there prior to, but hey, that's the way it goes. There we go. and your premium or your P&L is moving up like this throughout the day, up until it morphs into this. So we have this dual motion that's happening here, and we're hoping that our price is going that way to keep up with it, to keep up with this curve. So in the early part of the day, let's see if I can grab another. So in the early part of the day, I keep on, oh man. Let's see if I can grab a hold of this. You might start off here, and then as the market opens, you might move right up to here. Let's say that you moved right up to here, right? And you hit maybe 100% of your risk, and now you're up 100%. Right here being the risk from the zero line to the blue line, the flat blue line. So if you moved all the way up to here, now you're in a situation where you got to decide what to do. You know, how much of that profit should I hold on to? What if price starts going the other way? Yeah, let's see if I can. What if price starts going this way? Right? When do I get out? Well, that's where the when and where come in. While you're in zone 1 or zone 2 here in this area, not in the profit tent. Actually, even if you are in the profit tent and it's the early part of the day, let's say the first half of the morning session, you're going to have probably about a 50 to 75% mental trailing stop. And so if you hit 100%, that means if you get down to about 25% gain, you're going to get out. That's the first half of the morning. If you're in the second half of the morning, that same trailing stop that you're using of 50 to 75% should shrink down to about 50%. Now here's the nature of that trailing stop. As the day wears on, that trailing stop, or the tolerance that you're giving your trade, is going to slowly shrink throughout the day, and that's done in order to manage the gamma risk that's building. Now, what is gamma risk? Gamma risk is the slope. Is the slope of the profit curve? This slope. So you can see down here, early in the day, it's got a very shallow slope. So the sensitivity to price is very small. But as you go up later in the day, that slope increases. So now the sensitivity of your of price movement is increasing. And of course, when you get very late in the day and that same profit curve starts looking something like something crazy like this here. I don't know if it'll look, yeah, something like that. Now your slope and the sensitivity to price is looking like this. All right? So it's changing throughout the day. And for that reason, your tolerance has to change as well. So your trailing stop or tolerance starts very wide in the early part of the day and is slowly decreasing as you get to the latter part of the day. And you do this so that you're protecting yourself from the risk of going to zero and maintaining the profit that you have already, the unrealized gain. And at the same time, as long as price stays inside that profitable zone, you're giving it an opportunity to move deeper and deeper into your strategy. So that's really the game here, and you have to come to grips with the fact that most of the time it's not going to do that. When it does go in your direction, there's going to be about a quarter of the time, maybe less, maybe a fifth of the time that it will get into your profit tent. But that is only of that 50% of the time it goes towards you. The other 50% of the time it goes against you. So it really is half of that, about 12.5% of the time. And remember yesterday, I talked about the distribution of prices on a daily basis. And you saw that even in a trending market, and overall over the past 20 years, the chances of a daily move ending up or down is about 50%. And there's nothing you can do about that. That's the way it is. Now, if you're some spectacular technician and you can tell every day which way the market's going to go, hey, good on you. Then you do that. And if you can do better than 50%, I say that's great. Now, in some cases, you will be able to do that, but for a limited amount of time. For instance, if we're in a sort of a momentum run and we get like 3 or 4 days in a row, you're going to think that you're a genius because you could predict that the market's going to go up for 3 or 4 days. But then what happens later? It'll probably retrace, and then you'll have 4 or 5 days in a row where it goes down, and then it goes up again, right? So that's what you're dealing with here. You know that it's going to be approximately 50% of the time in your direction and 50% of the time not in your direction. So when it does go in your direction, you need a good strategy. And the strategy in general is taking into consideration these slopes, which are called gamma. That slope right there, that steepness, is the sensitivity to price. That is the formal definition of what gamma is. It is the sensitivity to price. And that gamma is changing. Yeah, I wonder why I can't grab a hold of that thing right there. It's like, hey, you can't grab a hold of that. Yeah, there we go. So that gamma is constantly changing. Later in the day, it's like that. Mid part of the day, it's kind of like this. And very early part of the day, it's like that. Right? So it's always changing. And what we're really looking for, if you would look at it from a height versus width, that is always changing. So here we have a very low gamma where there's very little sensitivity to price. Here we have higher gamma where the sensitivity to price is bigger. And here we have very high gamma where the sensitivity to price is, really dramatic. And you're going to experience all of that. And that is going to guide your tolerance and your expediency of getting and grabbing and taking and maintaining that profit. What you don't want to do is do something like this. If the market comes up to the right up to the edge of your profit, your tent of the strategy. If you're coming right out here, let's say that you're right here. Oh crap! Let's get rid of this guy. We don't need him. He keeps on getting in the way. Let's say that you end up right here, very early in the day, and the market decides not to move anywhere from there. It just maybe goes here and is staying there. And you recognize that, man, if I can get inside the profit tent, I'm going to make a crap load of money. But it doesn't seem to want to. And then you're waiting and waiting and waiting until that until this happens. All right? Let's see if I can grab that. That happens, and you're sitting right here, and gamma has come past you, and now you're at what is essentially a losing situation. Your profit is now down here. See? Because that's where the gamma curve is. So if you wait too long and ignore the risk of gamma and that time frame, you're going to sit there where you could have taken profit earlier, and it could have been very good profit, probably 200, 250, 300% of your risk. And if you're waiting there with the hopes of getting in here and it passes by, man, let's talk about that. I'm going to bring in the big head here, and let's see if we have any comments. All right, there are some comments, but we'll talk about that in a second. This is where greed comes in. You're sitting there, you have good profit. If you have a strong move like that on these strategies, You could be up 200, 300% and still not be inside the profit tent. It's early in the day. And now you have to make a choice. Do I hold or do I fold? Now, early in the day, we give it a little bit of room. And so you're going to give it some room to move. But as the day progresses, if it stays there, your risk of losing that profit is increasing as time goes on. Because as time goes on, that gamma curve that was really flat is starting to do this. And that risk, as it gets steeper, that's your risk going up. Right? So at some point, you got to say, look, I'm sitting pretty here with 200, 300%. I'm going to take it and then move on to the next trade. So those are the type of decisions that you have to make. You can have some level of rules. Like I said, here, I can show you a list of rules that I might put together. I put together a very rough list of rules here. Let's see. There it is. So here's roughly what I'm saying. Early morning from the open to 10:30, my tolerance is about 75%. Late morning to lunch, it starts shrinking down to about 50%. In the afternoon hours between, well, it says 1 to 3, but I would say anywhere from 1 to 2 to 1 to 3. It shrinks down to maybe 30, 35%. I'm inside the closing session. Now my tolerance is really way down there. If you're inside the profit tent, then that's great. You can use the profit tent walls as your escape reason. You can say, look, I'm hitting the wall. That's the gamma's going way up. I was in the center and I was up $1,000. Now I'm down to $800. I'm out. I'm done. Now, there's some nuances to this as well. And let's take a look at what some of these comments are first. And off topic. Did you contribute to ZF's at Sun? Off topic, I know. I was chief architect for professional services. So what I did was I was the lead on all of our tier 1 clients. Those were primarily on Wall Street and in the Northeast. That included the insurance companies and big banks. But I had an office down on in the World Trade Center on Tower 1 on the 24th floor, and spent most of my time literally on Wall Street, down at the exchanges, the NASDAQ, the American Exchange, or the big banks like Credit Suisse, HSB, TD, etc. And so that's what I did. I supported our projects and any new hardware or new projects that were coming up. I was kind of the lead that would decide how they were going to be apportioned and planned out and that sort of thing. I also went on most of the big sales calls, and at that time it was the dot-com era. And so that was a really exciting era, because everybody and his brother that came up with a new business would put .com on the end of it, and then Sun Microsystems was supplying them with the hardware and a lot of the technology and also support services to build their product. And so I led all those projects. Well, I wouldn't say I directly led them. Some of them I did, but I had a very large team of architects and also outsourced partners that we would bring together, and then I would oversee those projects. So that's what I did when I was there. All right. Let's see. So it is not unfair to say that my team during the dot-com era literally built out all of Wall Street, from the exchanges to the big banks to the investment houses, everybody, and all the new businesses popping up. All right, so hopefully that answers your question. Let's see. Tom Burke says, is the current price indicated on the graph? I wasn't indicating, I was saying that the current price could start outside. It starts way outside, out of the money. Your butterfly is way out here, and you're starting here at a market price. And when it starts going towards it, I was trying to illustrate that, right? JC, the opposite happened yesterday. I took profit instead of waiting, and it knifed down more towards my short. It's okay, though. Can't be greedy. Yeah, and JC, I would say that it's good to have these profit management rules and framework. They certainly help, especially when you're a beginner with these types of strategies. But anything can happen in the market. And when you're in one of these trades, anything does happen. Some days we get incredible intraday reversals and multiples of them. Other days we get impulsive moves that just go out of sight, and then big reversals, and then break through the session highs. Other days it just grinds and does nothing, or other days it just stays there. And anything can happen anytime. And some days you think that it's going to be a calm, tranquil day, and we're just going to go sideways, and you're waiting for something to happen. And then all of a sudden, some piece of news comes out, or an economic report, or some politician says something, or some other type of geo-macro risk evolves, and then the price just jumps. Well, this morning you saw that probably when you were watching the CPI. Why did the CPI jump up so high? I have no idea. It didn't look that spectacular to me. Everything met expectations. The year over year was slightly better, but the market seemed to like that. I guess they are thinking that this gives the Fed the impetus to lower rates some. So they get all excited, and so now they're valuing the market higher because they like the thought of future cheap money. So most of the time, you have to be an opportunist, kind of a sniper. You get some quick profit, or maybe later in the day, all of a sudden things move and you get some quick profit. I'm of the mind of thinking seriously if it's a good amount of profit. And sometimes with these strategies, it can be dramatically good, just to take it off and be happy and then move on. Other times, it's better to let the trade evolve. And then once it gets too risky to sit there and wait, then you get out. And then there are other times, like when volatility is super high in particular, where the rate at which you achieve a pin trade starts to increase. There have been some times where I've had 3 pin trades in a single week. Now, these are enormously large trades for a very, very small risk, and you don't expect them to come but maybe once out of every 3 or 4 weeks, 5 weeks, something like that. Sometimes you can go 6 months without seeing one, but to see 3 pin trades in a single week is like mind-blowing. So you really have to have both your rules, your discretion, and sometimes you have to be an opportunist. All right, James says, I think you explained it pretty clearly. The bigger problem is getting into profit in the first place. Well, yeah, and you have to have patience for that, and that's one of the reasons why we trade so small. We know that profit's going to come our way about 50% of the time. And even in days when it ends below our entry, sometimes you have intraday reversals and you make profit on it anyway. So in other words, I might have like a bullish bias, and so I put on a bull fly, and it goes against me the first part of the day, and then moves up in the mid part of the day, and then starts to go against me. So I take profit out, and then it goes against me, and it still ended down, but I ended up with profit. So I think the important thing is you need a framework, you need to be prepared, you need to have the scenarios built out in your head ahead of time after you've gotten into that trade. And knowing the market structure and understanding the nature of gamma and how it manifests itself over the course of the day is really your edge. All right, Ron Hilton. 0DTE student here. How you doing, Ron? Closed a 30 wide call at 520, paid $1. That's what I like to see. Over a 500% return. I got to 1150. it got to 1150. So he was a little bit slow on the trigger. This happens to me a lot. Like, you get distracted, you go to the bathroom, then all of a sudden everything turns around. Your wife comes down and needs to ask you a question, and you get distracted there. And of course, the trade always goes wrong when that happens. So, yeah, that's trading, but still 550%. You can't argue with that. And let's see, Midnight Blue. Can you demonstrate how to take profit? It still confuses me if I'm not letting it expire. Well, you can take profit anytime you want. Why do you have to let it expire? Why do you think that you must let it expire? All right, let me demonstrate it to you. Think or swim. All right, so I'm going to set up a trade, and it's not expiration yet. We're still 23 minutes away from expiration, and I'm just going to push this a little closer to the price so that I can do this. Let's say I go there, and I bring this there. No, I have to go a little further. Let's make it 64.60. No, 64.40. That'd be a good price. Yeah, right there. And we'll make this 64. $25, and we'll make this $6,400. I don't know if that will work. Maybe, yeah, something like this. Okay. And I think I need to expand this a little bit. Well, let's say that we're on this side of the market, right? We're over here. And then price ends up right here. Now, it is clearly another 22 minutes left in the market. I am right here, and the value, the real-time P&L, this purple line, is showing that the value of this trade is $883. I can take that trade right now without letting it expire. Why do I have to let it expire? There's no rule that says you have to let it expire to grab profit. I can take it right then and there, leave the game with $880 in my pocket. Right here, here's the real-time market, and it's a little bit to the left of the break-even. I could get out right now with $83, $93 of profit. Right now. And right there. Do you not see that? I don't have to get inside the profit tent. I can get out anywhere. Let's suppose that this trade is going to expire tomorrow. All right? It's going to expire tomorrow. All right? I'm sitting right here. Same trade, same strikes, but this is going to expire tomorrow. I'm sitting right here. It's going to expire tomorrow. What is stopping me from exiting this trade with that $600 of profit right there? Nothing. Absolutely nothing. So this idea that you have to let it expire in order to collect your profit is crazy. There's no basis for it. There's no reason why you have to let it expire. That's not the way options work. You can get out anytime. All right, hopefully that answers your question. And we'll go to... Does that answer your question, Midnight Blue? Hopefully. All right. Diesel Viper. I learned my lesson on letting trades run like that. Used to cost me money. It's higher. I learned to take profit and not be bothered if I could have had more. Waiting around and hoping is perhaps the worst possible strategy. Hope is not a strategy, as they say. Being more opportunistic when things happen fast, and if you don't understand what the dynamics are, my recommendation would be to close the trade. But the best way to act is to have precognition, that you already have a framework, you know when and where you are, and you know exactly how you're going to act. And so when I get into a trade, say earlier in the morning, I have already planned out various possibilities, whether the market's going to go up or down or stay right where it is. What is it that I'm going to do? How am I going to act? And what am I going to do if it moves in one direction? And when it does move there and I'm in profit, what do I do then? As soon as I'm in profit, I start asking myself, well, what am I willing to give up before I exit this trade? So until that event happens, then I'm holding my position. And then while I'm in that trade, I have to constantly update that idea. When do I fold? Because conditions are changing. And as you know, the risk is increasing. Now, if I start moving deeper and deeper into my trade and into the profit tent, it becomes easier, but that doesn't mean, or I guess your potential is much greater, but that doesn't mean that there isn't still risk, because the market can move at any time and move out of profit. So you have to be prepared to take the profit and be opportunistic when you can, once you've determined that the risk is too high to just do nothing. So that's the nature of trading. That's the way it is. You have to have a good plan, a good framework, and good intuition. And the intuition really comes from repetition. So for new traders, I would say that the best thing to do is that when you get into early profit, I would say get used to taking the profit. Right? Even if it's small, take the profit. Take it, often, so that you can get that feeling. And then also you will by nature experience losses that will go against you. So you have to take the losses. And you do that repetitively, and over time you start developing a little bit of toughness and some confidence in what you're doing, because confidence comes from repetition. And then over time, you can then start integrating this profit management framework, and then holding those trades a little bit longer and a little bit longer, and then maximizing your opportunity. So that's generally how I teach people to do it. It takes time, it takes patience, and it takes diligence, and good record keeping, logging, journaling, and then reviewing on a weekly basis. All right. So, hey, look, if you think that this was valuable, please hit that like button. Really appreciate it. And if you haven't subscribed already, make sure you subscribe so that you get notified. This show happens every day from 3 to 4, or approximately 4 Eastern time. And if you'd like to learn more about tail risk trading out of the money butterflies, how to take tiny risk for large potential gain, stay in the game, extremely low drawdowns, and you have that, doesn't everybody want that bottom left, top right type of equity curve with hardly any drawdown? If you want to learn how to do that, go down below and join our Fat Tail School. It's on the school community. All right, JC says, developing edge comes from experience. Experience comes from more trades. That's true. Of course, having a solid plan, a solid strategy that will keep you in the game is very important. But once you do have that, you're right. You have to do the repetition. Repetition breeds confidence. Confidence breeds success. Successful people generally are confident. All right. That's about it. I want to thank everybody. for the, let's see, I always have to look at what the right, oh yeah. I want to thank everybody for joining me here today. And later on, if you want to put a comment in the video, that'd be great. And we'll see you next time. This is Coach Ernie, and I am out. Hit the wrong one. There it is.